All right, hello everyone. Welcome to the fifth installation of the Future of the Cosmos Hub call. Today I have Sunny and I. It's a pretty quiet discussion today. Today we're going to be talking about liquid staking, validator shares, and what all that means. I guess you're pretty familiar in the ecosystem, but Sunny, you want to give a intro about yourself?
Yeah, sure. Hey, I'm Sunny. I've been working on Cosmos for a number of years, obviously at Tendermint and now at Sika, which is a validator company, and spent a lot of time thinking about staking derivatives. Wrote basically last summer, spent some time really thinking out a design of staking derivatives, and it wasn't really a priority back then, and so that stuff kind of got put on the side, and now I think people are getting just now it's now that other stuff is like Stargate and whatnot is coming to a conclusion, people are thinking of next steps, and so staking derivatives the conversation is bubbling up again.
Yeah, I guess let's kind of step back and kind of talk about what liquid staking slash staking derivative is. I think we had this the liquid staking working group calls. I think it was earlier this year, maybe it was late last year. Where I think that was one of the first discussions on staking derivatives in the ecosystem, and I'm really glad Cosmos kind of got to lead that. Yeah. So what is liquid staking slash staking derivatives?
Yeah. So give me 1 second. I think people are saying my mic is a little bit hard to hear, so let me see if I can just switch my mic to using the flat mic.
Yeah, for sure.
Okay, this is better. Sorry, I'm not at my house right now. I'm actually out in the woods with Phil Diane right now. But so what was the question again?
Yeah, what is liquid staking slash staking derivatives? What is the right term, and why is it relevant, I guess?
Okay, yeah. So liquid staking is essentially so what happens is in proof of going back to proof of stake, the idea is everyone has to stake, or at least in Cosmos instantiation of proof of stake, everyone stake bonds coins, and these bonded coins are illiquid and held basically by the protocol to be slashed when someone misbehaves. And this illiquidity is, necessary for a couple of reasons. One, it's so the right person can get slashed. So if I'm a validator and I have stake delegated to me, you don't want to. This unbonding period prevents me from quickly doing something malicious, selling my coins, and then allowing the slash to happen. And then also, Cosmos specifically, we take this this route of arguing for the security perspective of staking tokens, in the sense that unlike things like Ethereum, where we say it's it's more like Ether, it's more like money, and it's a staking with money. We tend to say, atoms are more like ASICs, where they're a piece of capital that you need in order to stake on to validate or stake on the network, and it earns you some rewards, usually in something else like other fee tokens and whatnot. And in that conception of the model, the illiquidity is sort of nice as well, where you want it to be kind of just like ASICs are illiquid in the market. It's very hard for someone to suddenly just show up and buy and with greater than 50% of the network, because it's just ASICs are slow to manufacture and stuff. And so by having that illiquidity in the network, that was part of the security model of of the Cosmos proof of stake, where it's if 80% of atoms are already bonded, it's really hard for someone to just pop up out of nowhere with way more atoms, because the market would detect this happening. So that's sort of where that all comes from. But then it turns out that this has some cons as well. There are downsides of having the all this illiquidity. And so there's a couple of big ones. One is you have like the challenges from exchange validators, where on exchange, like, for example, if you deposit atoms on Binance, they'll automatically like stake a portion of all the atoms on their platform and distribute rewards to all their like people who have atoms on Binance. And while they're doing this, you're still allowed to trade on Binance with those atoms. And so essentially, tokens on Binance are sort of like staking derivatives almost in a way. And so the concern is that, given the option, people would given the like everything, all else being equal, people would prefer liquidity on their for like personal reasons, right? And so then that's why we would see a much larger portion of atoms being delegated through the Binance platform. And so to combat this like threat of exchange validators, it can be argued that we should build some level of liquidity into the protocol so you don't have to depend on exchanges to provide you that. That's one reason for the liquid staking. The other is, it has the potential to be an interesting asset. So it's like a yield-bearing asset, essentially. And then you can go ahead and use this in like different DeFi applications. And yeah, and so really when we were like, I think one of the most interesting things is like, before we even consider that like mechanisms of how to do staking derivatives, I think it's, there still needs to be more discussion also, even like if we should do staking derivatives, right? And it's like we have to sort of balance these two, like the pros and cons of each side, weakening the security of our proof of stake model, but in order to create these interesting assets.
Yeah, and I think, like it's hard to attribute the fact that the Binance offers automatic staking on liquid tokens as the reason why they're the number one voting power in the Cosmos Hub. But at the same time, I do think that that's a pretty huge incentive for token holders, for them to actually leave their tokens in Binance, and we're seeing a lot more exchanges get into this, like Coinbase as well.
Mm-hmm.
And like I think I wanna another point that I do want to bring up is, like we saw the insane, APYs that DeFi offered during this crazy like DeFi boom in Ethereum, and like there's a fundamentally different interplay when something like this is working on like a proof of stake based network, right? Because when I think the reason why ETH was being used is not only is it like a base asset of Ethereum, but it's like one of the most liquid assets like out there, crypto assets, and the liquidity that ETH provides makes it an attractive asset for DeFi to use it as a gateway for to allow people to enter and lock up their funds, provide liquidity into these DeFi applications. And at least in Cosmos, we know that Atom is the most liquid crypto asset that exists here, and and it offers a lot of fiat gateways in different countries as well. But the issue that you have when something like that happens is that there's this whole idea of like competing interest rates, right? So obviously there's a lot of different risk factors that exist, but when a DeFi app offers you 40% return when you put atoms into their some types of savings application, the incentives are there for people to unbond their staked atoms, which means less security for the Cosmos Hub. But speaking of like incentives from a purely selfish incentive like mechanism, like atom holders' incentives are to kind of maximize the profits that they can get. And I think staking derivatives / liquid staking is a really good way to kind of solve the issues that exist around this ecosystem. So
and I mean, essentially, and like I said, I mean, this all just has to be balanced again. Like, we have to accept that what the trade-offs are, that we are going to be weakening the security of the proof of stake system, and just make sure we're clear about the trade-offs and stuff that we're making.
Yeah, and let's actually kind of dive into that because I think staking derivatives is like a very big concept, and I think it always comes down to the details of like implementation. So
Mhm.
like one thing that I see is like um, and we're gonna be more like talking in the Cosmos specific sense of things like slashing, tombstone, and things like that.
Mhm.
And like how is slashing handled, right? Like you can create a very fungible token that's fungible across different types of validators, but what happens when I stake to one validator A and um, Bob stakes to validator B, and when validator B gets slashed, does that mean my liquid atoms are worthless because of someone else's fault? So I think that's a very clear trade-off that exists,
Mhm.
and
Mhm.
I think another thing is like like I do agree that like we may be weakening some parts of like proof of stake security, but I don't think it fundamentally like breaks the base assumption of like the you need 33% voting power to do something malicious. You need 66% or more to completely change the ledger. I think like liquid, it seems like liquid staking makes it easier to gain, like leverage staking and gain voting power, but I don't think it breaks the fundamental like security assumption of what Tendermint and BFT provides. Like, would you kind of agree with that?
Yeah, right. So I mean, it's so with the liquid staking derivatives, it's like someone is going to get slashed. Like if misbehavior happens, we're still going to slash the tokens. But it's just the question is it the right person that we're slashing, right? Because with the unbonding period, if you are delegated to validator that misbehaves, and you can't like quickly sell your tokens before the slash happens, but here you can, and so that's just sort of the risk that has to be um like that's the only thing. It's like the security is still kind of the same to the protocol, but it's like if you can get away with it and get someone else in trouble instead of yourself, then you might be more willing to do malicious stuff.
Mhm. And I guess we should dive into validator shares before we talk about some of the security risk that exists in this model. Um,
Mhm.
so yeah, like can you give a brief overview of validator shares and why that's different from some of the other proposed like liquid staking solutions that are out there?
Yeah, sure. So with validator shares, I mean, it started sort of originally as this like protocol that Sika was working on with Chorus One, called liquid staking vouchers, where essentially what's happening right now in the state machine of the Cosmos SDK already, there is how we track like delegation rewards and everything is when you delegate to a validator, you get back this like delegation share. Like it's already there in the state machine. And this share is used for like internal accounting to see like, okay, to make sure let's say I provide like 10% of the delegation to a particular validator. Um, I'm basically earning 10% of the rewards of that validator, and I have the right to withdraw 10% of the like total delegation of that validator. And so, and this is done for like lazy accounting purposes, essentially. What I mean by that is like one of the things that we want to do in the Cosmos Hub is we don't want to to distribute rewards. We did not want to iterate over all the delegators because that would just be way too computationally expensive. There could be
Yeah,
our
yeah.
expectation is millions of delegators. Our rule was we only ever want to iterate over the validators, which is a much smaller number. Let's say 125. Um, and so that's why this delegation share system it's called F1 fee delegation or F1 reward distribution and all this stuff was invented to have that computational efficiency. And now, but then the idea was, hey, if we already have this internal accounting tool called a delegation share, why does that have to be like an internal tool that's like, just used for internal accounting? Why can't we just
Mhm.
tokenize that, right? And like you see this trend happening everywhere in crypto where it's like just look at Uniswap, right? Like you could have if you when you provide liquidity you could have it could have just internally kept track of like, oh, this person has this percentage of liquidity. But it's like, no, why not just tokenize that as well? And then you can do like weird, crazy stuff with it. And so it's the same thing here. Why don't we just tokenize that staking share or delegation share, and so people can transfer that around? Then once you do that, then that's like a great first step. And then once you get further into that, you start to realize, oh, there's all sorts of like complications around the way things are designed in the Cosmos SDK, especially around like reward distribution.
Mm-hmm. Yeah, and I think like, and I think that's actually like one of the biggest strengths of the validator shares model is like, it seems like a lot of the work that's needed to implement this is already like there at the distribution module. And we're basically kind of following the whole, like, you could have kept Uniswap LP tokens like internally, but you could tokenize that, and that's how you see, these like all these farming rooms where like, they're reutilizing these LP tokens that were technically meant to be, like a internal like ledger that were just tokenized, and they're reutilizing that to build an additional like layer of incentives for a new protocol, and and maybe go beyond that into using that LP token for something else. And I think this is like the most interesting. I do think that liquid staking is the most interesting thing to happen for like the staking is DeFi narrative, because like I think people have been saying like, staking is DeFi, but we haven't seen the composability aspect of like staking really kind of come through until something like liquid staking and validator shares were proposed. And and this, I think this is where it actually feels more tangible that like staking can be used as like a composable like primitive of the wider like DeFi like financial market, right? So can you kind of explain the rewards part, because I think that's something that a lot of people don't quite understand, with potentially like the fees and the complications that exist there.
Sure. So there's sort of, I'll give like what would be the I don't want to say the ideal, let's say, but the simpler model, and then the more complicated model because of one feature of the Cosmos SDK. So the simple model is, let's assume all rewards and all fees for given to stakers are all done in the staking token itself. So on the Cosmos Hub, it's all done in atoms. This is really easy, or much easier than, because so what currently happens is once again, like already in the internal accounting tool, what happens is if a validator, so initially there's like a conversion ratio between a atom and a delegation share, and it's 1-to-1. So let's say you delegate 10,000 atoms to this validator, you get 10,000 delegation shares. But what happens if that validator gets slashed, right? It's let's say it gets slashed like 50%, right? So now it only has 5,000 atoms left. What that does is, but you have 10,000 shares still, because like I said, we're not going to iterate over all delegators just every time there's a slash. And so let's say someone else comes in with another 10,000 atoms, and now the total number of atoms in this entire validator is 15,000. But if they only get 10,000 atoms and you have 10,000 shares, and you still have 10,000 shares, now you have that's giving you the rights to 50% of that overall pool. But the problem is, you got slashed. You're not supposed to be getting the rest of that pool. So how the internal accounting does that is it changes the conversion ratio between shares and atoms. So if the existing thing got slashed by 50%, when someone shows up with 10,000 atoms again, now they're going to get 2 shares for every atom. And so now there's 15,000, but they have 20,000 shares. You have 10,000 shares. So this is already done. Now, and it handles this when slashing. But now what we could do is for rewards, we could do this in the other direction. So currently the Cosmos Hub doesn't auto, this is like a common question I get often, like, in our validator support channel, which is like, oh, where are my rewards? And it's like, currently in the Cosmos Hub, you have to do a transaction to manually withdraw
Mhm.
your rewards and redelegate them. But
Mhm.
if all rewards were in atoms, what we could do is actually just automatically redelegate all rewards. So rewards wouldn't show up, wouldn't be unbonded immediately. They'd by default be restaked. And so this would essentially, what it would do is every time rewards are given, it would just change the conversion ratio, but in the other direction. So it will, in slashing, the conversion ratio is going up, like you get more shares per atom. Here, because the reward pool is growing and growing, the total delegation pool is growing and growing, then it's just going to change. Conversion ratio is going to be decreasing ever so slightly. But that's fine. And so uh that would be perfect. Like, or that would be like very easy to pull off. And
Was was that actually like the reason why, like, is the distribution module built to kind of manually withdraw to accommodate multiple fee tokens, or was there
exactly.
something else in that? Okay,
No,
gotcha.
that's basically the reason. Like the reason.
Gotcha.
So now on to the complicated. The Cosmos SDK module does not work like this. Delegation, all rewards are not automatically rebonded. Why is this? Because rewards might not be in atoms. There's
Mhm.
currently are one of the design goals of the Cosmos SDK was to allow fees and rewards to be in tokens other than atoms. And
Mhm.
this has there's many reasons for this. So one is for fees, because we just wanted it so you can pay fees in any token you want, whether it's Bitcoin or any whitelisted token, so Bitcoin or Ether, DAI, Atoms, whatever you want to pay it in. And this is just for UX purposes. I always say one of the worst parts about Ethereum is the requirement to pay transaction fees in Ether. Like once I was very excited to show a friend how to use DAI, because I was like, oh, this is going to be so cool. And then I sent them some DAI, and then they're like, wait, why can't I send this? I'm like, shit, you don't have any Ether. That's like so annoying.
Mhm.
Um, so for UX purposes, that's one thing. Um, but that can be solved. But because what you could do is, if you have some way to sell off all the fee tokens and convert them to atoms. So let's say there's an AMM on the chain, then you could just auto convert them to like sell them and buy atoms and distribute the atoms to the stakers. Or
Mhm.
what Chorus One suggested was to do a auction. So like every 12 hours or something, it'll just collect all the fees that have been accumulated, and every 12 hours we'll just auction
So,
all of them off for atom.
mhm.
That's one way of
Yeah,
doing
and
it.
I see opportunities where like a lot of these like complications from like a user's perspective could be kind of
Mhm.
abstracted at like the front end level, at the wallet level, or if there was some mechanism where someone else could pay for someone else's transaction, like like
Yep.
a wallet just pay for their transaction and just take a certain amount of tokens in return. And from a user's perspective, that'd be pretty seamless. It,
Yep.
it would seem like, yeah.
But then the problem is, I think rewards are more than just fees. Like, there's other reasons why rewards will be in other tokens other than just fees. So one of them is, we want to get into a shared security model for the Cosmos Hub. And let's say you have a chain that's being secured by the Cosmos Hub, um, but it also has its own native token that's used for other things, right? Let's say maybe it's a governance token for that platform or something like that. And it wants to provide rewards to the Cosmos Hub like stakers that are securing the chain to better align incentives. But now, if we force it that, like, oh, you're not allowed to give rewards in another token, I think that's sort of a big drawback, where it's like, oh, you're not allowed to. You're trying to align incentives better, but because of our system, you can't do that actually. Another example like that was a more practical one is like, well, not practical, but like an example that's already happened actually was, I forgot what proposal number it was, but from the cyber Congress team, where they basically were asking the Cosmos Hub as an entity to basically participate in their fundraiser from the community pool. I think Sika actually voted no on that, but I kind of regret my vote on that, and so I'd like to we'd like to write up a blog post at some point explaining why. But that would not have been possible. Part of how that would have worked was atoms were going to go out of the community pool of the Cosmos Hub, and then the cyber token was going to be just. I think now there is I don't know if it's there in the current version, but it's been I think there's already it's like been spec and stuff where you can just send tokens to the reward distribution mechanism, and it'll automatically distribute rewards. And so it's like that'll have been cool. Like so then the cyber team, once the token is launched, they can just send the tokens to the reward distribution system, and it will automatically get distributed to all Cosmos stakers. But now the problem is we can't do that if we say, oh, you can't send non-atom tokens to the reward distribution system. And so that's sort of, and so I think basically the Cosmos Hub community has like a decision to make going forward here is, do you want to restrict rewards to only be in atoms or not? And like I said, just because rewards are in atoms doesn't mean that like the payments have to be in atoms. Like for fees, we can throw it through an AMM, or technically we could also just like the cyber tokens that are coming in, we could just sell all of them and buy atoms with it. But it's like I don't think that's what they were trying to go for. I think the goal
that seems completely antithetical to the idea of like the Cosmos Hub bootstrapping a new.
Then why did we even participate in the fundraiser anyways?
Exactly. I see. So there's not a good solution where you could have multiple fees being distributed without, computationally heavy, like
there is
ledger management.
There is a solution that works, which is what I wrote up in the spec last summer, but it does have a weird, quirky UX issue to it. And that UX issue is that every time a transfer is made, you need to make a transaction letting the Cosmos Hub know. Because what happens is, so how it would work is, let's say Alice is delegated to Sika and is earning rewards. She takes her staking derivative and sends it to Bob. Bob now has the staking derivative and can withdraw the delegation atoms. Like so we're back in the model where we're assuming rewards are not auto redelegated. You have to withdraw again because we have multiple reward tokens. So she sends the tokens to her staking derivatives to Bob. Bob now has the ability to withdraw withdraw the base staking amount, but he's not earning rewards yet. Alice is still earning the rewards until Bob makes a transaction saying, hey, I'm the new owner, switch the reward address to me. So that sounds not that bad if we're on the Cosmos Hub, right? Because if we're on the Cosmos Hub, then we can just go ahead and we can, if we wanted to, we can even program it so every time these staking derivatives are sent, it automatically, just as part of that transaction, updates the reward address. But the problem is, what if these tokens are on another chain completely, right? Like, what if they're on Ethereum or Kava or somewhere else? Then, when you do a transfer there, it would be really annoying. You'd have to make a transaction, letting the IBC transaction, letting the Cosmos Hub know that, hey, by the way, update this thing. And so that that's a major UX hurdle there. Maybe this can all be abstracted away by wallets, but also then you also get into other stuff with how do how to make it easy for smart contracts to do this as well. So this is one of the sort of main big concerns.
Yeah, that makes sense. So it's a series of trade-offs, but I do think there's a lot of good, the pros of Validator Shares exist, and I don't think we've covered enough of that yet. I think people might say, the fundamental downfall of Validator Shares is the fact that when you have 125 validators, you're going to have 125 validator shares, right?
Yeah.
And that means you're splitting up the liquidity of liquid staking tokens into 125 proportional to their voting power.
Yeah.
And and obviously there are ways to move around this. Can you kind of briefly explain about some of the mechanisms that could work to increase liquidity while still working on this validator shares type of model?
Yeah. So there's like different ways of doing this. You could have sort of, and a lot of them are like taking the you pool different you take the shares and then you pool them together somehow. So one option is you could use something like Curve Finance, where Curve is basically, it's an AMM, but like heavily optimized for like when assets are pretty in like equal valued.
Similar
Uh,
prices, yeah.
yeah, and like move together essentially. So in that, it's like, let's say we could make a giant Curve Finance pool that says, okay, it's all 125 validator share. And so it's easy to convert between any of them pretty easily. That's one option. Or, you could just have people go ahead and just make like their own like pools where they say, hey, this is like, I think these are like the top 10 validators, and anyone can just go ahead and deposit like the shares of any of those validators, and it'll mint one token, and you can use. I mean, I guess that's actually the same thing as Curve, I think, basically. Yeah, so you could go ahead and like put one into there and deposit and withdraw whatever you want, and so it's basically like fungibilizing all of these by like you're basically now owning a proportional share of the risk of all of those validators.
Yeah, it's basically like a liquid staking ETF, right? Like a validator share ETF, and you basically get to share the risk of every single one of that, but you get maximized liquidity out of it as well,
Right.
which is a huge plus, right? And and I think the part that I really like about this is like it gives people the option to opt into this kind of a system rather than this risk sharing system being the fundamental liquid staking protocol that exists at the base layer. Because some people might not want that, right? I might say that I just want to trust these set of validators and not these. So it gives an option for them to basically opt out of something like this. Another thing that I've actually thought about was pretty interesting is that if I'm a small validator and I want to incentivize people to delegate, I could essentially buy my own validator shares, where the price of my validator shares increase over the cost of one atom, and there exists an arbitrage opportunity where people would delegate to my validator and convert them into these shares and sell it for profit, right? Obviously, it's not a very sustainable model, but it could be some type of a promotion thing. And like it's so composable in the fact that like it's an actual validator share, like it's a membership of someone who has who shares the risk of me behaving. So I could say I'd be willing to split my profit from some other blockchain with people who are holding my shares, and it creates this very simple mechanism to do that, right?
And I think what's also cool is it's very easy. Yeah, it's a good primitive to be used in a lot of other things as well. Like I'm sure, like given this, there's also really cool like slashing insurance stuff you could build.
Yeah, exactly.
And also, like so one of the things that the Bee Harvest team is kind of working on, and I think they originally wanted to build this as like an alternative to validator shares, but I think I somewhat convinced them that this might be a add-on to validator shares. Is you could also, let's say you do want people who don't, let's say every validator share has some risk profile. What you can say is like you could do something similar to what Maker does, essentially, right? You have all these different collateral tokens that do have different risk profiles, but what you can say is like, hey, okay, what you can do is take a cut some portion of that. So in Ether, let's say, I think they take like 2/3 of that and give you a fungible token out of it. So it would be DAI in the maker case.
Mhm.
But here we can say that like, okay, all of these validators, let's assume that like any of them, maybe a smarter system would actually look at the risk of each individual validator. But you could say like, okay, let's say assume 20% of the validator is like risky. And so you split that out, but you say, okay, 80% of the value of that validator is relatively safe across all validators. And then we can just go ahead and like create a fungible token across all of those. And you can have like, so the validator shares be the collateral in this system. So that's the other option as well.
Yeah. And I think like the thing, and I'm glad you mentioned insurance because like I think insurance is one. It's so simple to implement validator insurance with this because you can basically use options like call options or put options where like you just create a smart contract that says should the conversion ratio of this validator share to Atom fall below a certain limit, like I will buy this amount of like
Yep.
or I will provide a certain amount of Atom to this rewards pool, and like that's insurance that like it's
Yep.
just one simple, super simple smart contract that exists, completely decentralized, trustless, and
Yep.
that guarantees the sum slashing up to a certain limit, and I just love that like you can implement validator insurance that simply like just using this primitive of like
That's what like
validator
my
insurance.
friends at Open. So my friends created this company called Open, and that's what they do on Ethereum. They basically built a
Mhm.
platform for put options, and they market it as insurance. And I think this
Mhm.
is like so cool because I really think the most interesting thing. I think I mentioned this on one of the previous Cosmos Unchained ones, which was I think one of the most interesting things that DeFi did was tokenize everything. And I
Yeah.
think like I think it was the one with SBF, and I remember we were discussing about like, I mean, one of the most interesting things that happened with Uniswap was we tokenized liquidity, and that was such a cool concept because that's what allowed sushi to work, like the sushi
Yep.
saga to happen, is because we tokenized liquidity. And I think this by tokenizing things, now you can like a put option can be insurance on almost anything, which is like such a
Mhm.
cool concept, right?
Yeah, exactly. Yeah, and like maybe I have some friends, like validator friends, who I like to share my risk with. I think I discussed it with someone where like um, I heard like there's the whole reinsurance markets where like this someone who's running an insurance company in California might buy reinsurance in like I don't know Jersey or New Hampshire where it's geographically completely separate.
Yeah.
But it just kind of mitigates, averages out the risk that they each share. Uh, and I could basically do that with other people's validator shares, right? Like I will cover up to this amount for your validator's loss if you do that for mine as well.
Yeah.
And I think that kind of creates a very interesting, like, like a new way to build financial markets around slashing, being able to, put numbers behind risk and then, yeah, and just like build something out of it, right? So.
One question though then is like, what happens when like what's going to be the so let's say, okay, staking derivatives take off, right? Any exchange is not going to want to list atoms anymore, right? They're going to want to list staked at like some staking derivative, and not on like CFI, but not on DeFi where like the curve stuff kind of solves it, but on CFI, which index are valid are exchanges going to list?
Mhm.
And like, are we going to have like, is there going to be a high amount of fragmentation of indices or not? That's
Mhm.
like a
Yeah, because like Binance could say, I will just create an index of the top 10 validators, and
yeah.
the liquid staking out of this would be the one that we list as liquid staking atoms on Binance. And, the incentives are there for people to basically stake all of their validators to, to this
Yeah.
top 10 or maybe some other, exchange curated list. And, you know, It basically makes the validator submit to the higher powers of the exchange who are basically curating these things that they provide liquidity to. So,
and I wonder what's going to end up becoming more popular. Is it going to be so for full disclosure, this is something that Sika has been like looking into, is potentially creating like an index for this. And so what's going to be more popular? Is a governed index going to be more popular? I guess it's like kind of like, in normal finance, it's like active funds versus passive funds, right? Where it's like, are people like, if Sika is making governance decisions, or we have like where we are saying, okay, let's redelegate to this validator, let's redelegate here, or would a passive fund, which is like, you could create an index which is saying, hey, we're just going to delegate proportionally to what's already there. So, if like one validator has like 3% of the voting power, we're going to delegate 3% of our assets to this one, and you could just have spread it out evenly. So I wonder which of these two models is going to end up becoming more popular.
That's interesting too, because with validators, they have a lot of power with governance as well. So you could essentially buy votes by incentivizing people, like increasing the price of shares that aligns with your vote, right? And that's a fairly easy thing to do. And with these index fund type things, where I think governance is going to be an interesting aspect of that. But I think it's also a good reason to have. I think the reason to have highly liquid, highly efficient DeFi on chain is so important at this phase, because people want liquidity, people want efficiency, and that's something where centralized exchange really excels at, whereas DeFi hasn't been. And we need to kind of have this really good alternative where the incentives, the trade-offs of using DeFi versus CeFi isn't that great. And it allows them to, be like, okay, like a decentralized financial product will, do the work just fine, rather than having to rely on centralized exchanges from some of these indexes, right? So.
I mean, I think some of it comes into DeFi as well, though. Like, let's say Maker. Let's say we wanted staked atoms to be collateral for Maker. Is Maker going to suddenly start accepting all 125 of the Validator share tokens as collateral, or are they just going to choose like one index? And if so, how do they choose which index to use?
But I mean, I think that would most likely depend on whichever is most liquid, I would assume.
Right.
Yeah. So whoever has that, like head start, I guess, is will likely kind of gain that early liquidity, which would kind of snowball into more liquidity down the road.
Yeah.
I guess in cases of where like the validator set changes in these indexes, like what would happen?
Sorry. Oh,
so like,
yeah, I mean the index would still, the share is still like, let's say you have a share for a validator that's not is on the edge, and they drop out of the top 125. Your shares are still like usable to withdraw your delegation and reward. I mean, that's basically what still just happens today. I mean, we still, if you're delegated to validator and they drop out of 125, you don't like lose your delegation.
Lose your money. Yeah. But you still have to basically bring this index token back and withdraw.
Yeah. By the way, it's also maybe another thing also worth mentioning is it's very easy. So the way that it's designed is so in the Cosmos Hub, one of the things that I was like really, my biggest contribution to proof of stake is this idea of instant redelegation, which is you actually can switch from delegating to validator A to delegating to validator B without unbonding. But what it does is it puts you in this pseudo unbonding period, which is while you're delegated for the first, let's say the unbonding period was 3 weeks for validator A, you're in this like, for this 3-week period while you're delegated to B, you're actually liable for both defaults of validator A and B. So this is kind of like, that's fine for most people. But then the problem is that the delegation share of your delegation share, which is actually viable to the fault of A and B, is not actually fungible with the delegation share of someone who's only liable for the fault of B. And so most delegations are going to be only to B, like only liable for one validator. But it's only for these ones that are in the pseudo unbonding period where they actually how to deal with those. I mean, I think the easiest way the easy way is to say, oh, you don't get a share. Like, you don't get a delegation share until you finish your pseudo unbonding period, which is one op. But that's just something to keep in mind for how that will, if that impacts anything. I don't think it should have a huge impact, but
yeah, and I don't think it's like a dramatic departure from what we have with like if you want to switch accounts and you have staked atoms, like you're gonna have to unbond and
yeah,
and move your liquid atoms to another account and bond there. So
yeah,
I feel like that's a fairly reasonable trade-off to exist in terms of that. Do you get a chance to kind of look over some of the bharvest proposed design with shares that have like expiration dates and how that compares to just validator shares that you proposed, I guess?
I looked at an earlier version, like from they've been iterating quite a bit on it. So I looked at maybe the version from a week ago. That one I don't think had the expiration dates. So I guess no. Sorry, I actually haven't.
No, that's fine.
But I mean, I'm sure I probably have a general idea of that, and I mean, I like the idea. I just think it should be like, I'd prefer like that should be done at a higher layer, like using staking shares as a primitive. Like, for example, Open, like the options protocol, they do have expiration. So they have options with expiration dates as well, right? And I think but like that's not so I think you can build stuff with expiration dates and all this like more financial engineering to like fungibilize it and better and stuff, but it should be built using it shouldn't be the base staking derivative system. Like the base system should be an easy primitive that's like adaptable by many things.
Yeah, and I think the part that I was a little bit skeptical about was like there's basically a parameter where there's an expiration date where these shares expire and then they mint new ones. But in between these two periods, basically you're not able to mint new tokens until like the next period comes, and that creates weird mechanisms where like people aren't able to like live arbitrage the price differences, and like you could have even though no one has been slashed, you could your shares could fall down to 0.8 just because someone was just selling a ton, or it could increase a ton, and there's no good way to basically kind of like bring that through the mechanism of arbitrage. So I think that's one part where I didn't quite feel like didn't feel efficient, I guess.
Yeah. By the way, this is sort of semi-related. There is a third option that I feel people don't talk about as much of how to do reward distribution. Is what if we do just iterate over all the delegators? Like I said, we don't want to, and it's obviously like completely infeasible to do that every block. But what if we say that, I think most staking systems on other chains are using like an epoch basis, where like in the Cosmos Hub, like the values that can change every block if you want to. But most chains are saying like, oh no, like we change the validator set every epoch, and this epoch could be, however long you want it to be. And so maybe it's like at the end, and the validator and the delegations don't take effect until the epoch happens. And so maybe it's like during that period, it's okay to like just let's say the epoch is once a day. Maybe we just have one block that takes like 30 seconds, but just does the iteration over all the delegators. It's just like absurdly expensive computational block, but maybe that's okay. I don't know.
But I mean, if you implemented Validator Shares as not a native module, but like as something completely off chain, like as a separate zone, like I mean, they could also technically do Validator Shares and create these epoch types where, um, it wouldn't take longer for the Cosmos Hub to generate blocks, but basically you could, maybe, say you could batch a thousand blocks and say, whatever transaction fee was generated in this 1,000 block period will be just distributed equally to whoever's holding that share at that time, right?
Yeah,
So
by the way, sorry, now that I'm thinking about it, this doesn't actually solve the problem of like needing, even if you distribute to all the delegators every block, it doesn't actually solve the problem of like, oh, you still have to let the Cosmos Hub know that the owner has changed. So
and if we're
never,
gonna do that, it's just easier just to do the second
yeah,
way.
never mind that. Sorry, I'm just thinking in the context of so I am working on a version of the staking module that does do epoching for like a project that I'm working on right now. So I guess I just got caught up in that. But yeah, you're right. That doesn't solve the problem.
Yeah. We're slightly out of time, but I do want to answer this question real quick. Someone said that, don't you think that a top 10 index would lead people to delegating more to those top 10 validators? Yeah, and I think the answer is yes.
Yeah, I think I agree. I think the answer is yes, and that's why maybe we should think about more fair indices, and it's really hard to tell what people will delegate to or not, right? It's like,
Yeah.
and there's also this like level of you can just make it. Can you make it easy to convert between, let's say, another index and this top 10 index? You can, once again, everything is tokenized, right? So if the index shares are tokenized, you can put those in a curve pool with with other indices, and you can make like meta indices.
Yep.
So that could be interesting to see what
Yeah.
happens.
Yeah.
But
And like,
if we're seeing passive indices, I'd like to see some things that are more mindful than top 10. Seeing stuff that like, okay, proportional to all validators or something like that.
yeah. And it's like, it's if assuming that, validator rank is a competitive market, I think what's also nice is that like Validator Shares gives a mechanism where these smaller validators can use these shares to build some type of a financial product that incentivizes delegations to their specific validator. Maybe not directly like in an index, but they could offer like insurance and some type of additional rewards for people who are holding these validator shares, and that could just be implemented as a smart contract on another zone or something else, and that'd be
Yep.
fairly simple. So it gives a tool that's fair to everyone, I think. And if you're down under, go ahead.
So what would be really fun as well is just also being able, like going back to the composability, to use these shares to do voting. Like there's all these like great voting tools that are being built right now. Like on Ethereum, there's this cool called Snapshot, which is like really awesome. And it's like I'd love to be able to have like voting, easy voting, but only for my SICA delegators. I think that'd be really cool. And have a token be a voting token.
Yeah, I agree. And like, maybe you could work with a wallet where you get premium features if you hold like 100 validator shares of my, delegation vouchers, and you can take this even off chain and work with partners or friends that you have to offer incentives. And yeah, it's like I think it's all kind of up to the imagination. What's really powerful is that it's just a tool that enables you to build that.
Yeah.
So yeah. Cool. Happy to take more questions if you guys have more. But yeah, anything else you want to talk about before we end it?
No. Just that, like I said, SICA, we are interested in building an index system. And so if anyone's interested in helping us build this, please reach out to Sunny at SICA.tech.
Cool. Well, I think that's it for today. Thanks, Sunny, for joining. That was a lot of fun.
For sure.
And yeah, I really want to see Validator Shares being built on Cosmos. It doesn't have to be, Cosmos. Anyone can build it. I'd love to see that. So please, if you're interested, like get started on it. And I think we're gonna have a lot of people who be interested in like actually help contribute. So, yep.
Oh,
That's it
someone
for
asked.
today. Oh,
Mhm.
sorry. Go ahead.
Someone asked a
Uh,
question.
what do you think of incentives for staking for a longer period of time?
I think that's like interesting. So one of the things so at the hackathon where Course One and Six, I sort of built the staking derivatives thing. I also wrote a token lock module, which is, let's say I wanted to, as a validator operator, um, I have my like self delegation, and I want to really, I'm the one who should be the most like bonded in a way, because I'm the one who really has the ability to easily go like do something malicious if I wanted to. Um, and so what I said, and so I don't want to like, I want my delegators to have like liquidity on their staking delegation and stuff, but I'm a much more longer term like holder, obviously, as a validator operator. And so what I wanted to be able to do is take my staking derivatives and put them in a lock contract, so that that way I can't go ahead and just resell them. And so I think that it would be interesting that, maybe you do reward people for like not asking for liquidity on their atoms, right? It's like, okay, here I'm putting in a lock contract, it's untransferable. And I don't know if that should be done at the protocol level or maybe at the validator level. I'm not sure, but yeah, I think that this like makes sense. And I think for example, the Akash network, I think they have something where it's like you can choose your unbonding period. You can choose like 3 months, 6 months, or 12 months, and you get a higher reward rate
Mhm.
based off of what unbonding period you choose. And
Mhm.
so I think that's actually a pretty interesting thing to look into.
Yeah, yeah, and seems pretty similar to vesting periods and um for a lot of these investments that happen in crypto
Mhm.
as well. I think Avalanche also did something like that, where if you vested longer, you get a better rate on your like fundraiser ETH. Like you get more AVAX
Yeah.
tokens than if you just got it without. So yeah,
There's
that's
another
interesting.
question about the yeah.
Are you guys leaning more towards staking derivatives or Jay's photon token idea?
I think that they're not very like
Yeah,
comparable.
I
They're
think
like
they're kind of
they're
solving
basically
very different.
orthogonal.
Yeah, yeah,
Yeah.
yeah.
I don't know. I feel the photon token idea is still a bit underspecified, and so it's hard to provide much comment on it. But I don't think, from what I can tell, it's not solving the same problems as staking derivatives.
Yeah, I would agree with that. I think it's a complete different area. Obviously you could use staking derivatives like similar to currency, but I don't think that's the core thesis of like
Sika
why you
atoms are
should
money.
have cicadas or money. Yeah, you should turn that into a meme. But yeah, those two are I think completely different approaches. Um,
Yeah.
cool.
Cool.
All right. Thanks, Sunny.
Awesome.
Um,
Thank you guys.
and thank you all for watching. Bye.
Bye.